On July 4, 2018, Hong Kong passed the Inland Revenue Amendment No. 6 Ordinance, which became effective on July 13th. The major provisions of the transfer pricing regulations apply for a year of assessment beginning on or after April 1, 2018, where certain provisions are deferred to April 1, 2019. It's also confirmed that the territorial source principle of taxation will not be changed. Taxpayers should first compute income and profits on an arm's length basis and then apply the territorial source principle to determine if such income or profits arise in or are derived from Hong Kong. The new Inland Revenue Amendment No. 6 Ordinance covers a number of key issues, and most important is transfer pricing. Hong Kong is codifying the arm's length principle into the new law, and we adopt the OECD authorized approach, that is the AOA, in determining the profits attributable to a permanent establishment of a non-Hong Kong resident, that is the separate enterprise principle. We are also codifying the advanced pricing arrangement into the law and extending application to unilateral APAs. But the Hong Kong Inland Revenue Department will charge an APA application fee up to a maximum of $500,000 Hong Kong dollars. The three-tiered transfer pricing documentation is also introduced to Hong Kong, which includes the country-by-country report, the master file, as well as the local file. And last but not least, we also have a new domestic permanent establishment definition, which follows the BEPS Action No. 7.
The Hong Kong TP rules allow domestic transactions not follow the arm's length principle, as long as there is no potential Hong Kong tax advantage, if satisfying the three conditions at the same time. The first domestic nature condition requires that the transaction takes place between two Hong Kong entities, but not cross-border transaction. The second condition includes two options to qualify. One is no actual tax difference, which we will further explain shortly, and the other is not business loan arrangement. The third condition is that the main purpose, or one of the main purpose of the transaction is not for tax avoidance purpose. Now, how to interpret the second condition of no actual tax difference? First of all, two-tier profit tax rate and partnership regime are not considered as actual tax difference. In addition, if one Hong Kong entity is making profit, but the other has accumulated tax loss, the timing difference alone would not be considered as actual tax difference. But in case a Hong Kong entity is entitled to tax concession or exemption, such as corporate treasury center, or even not subject to Hong Kong profits tax, it cannot apply the domestic exemption. Regarding permanent establishment or PE, there are two important updates. One is the new rule introduced the domestic PE definition. It adopts the PE definition from OECD Action 7. And we also need to consider OECD's new action against artificial avoidance, such as anti-fragmentation rules. As the second important update, the new rules adopt the authorized OECD approach, or AOA, to determine the profit attributable to the PE. This will be effective since the year of assessment on or after April 1, 2019. We are awaiting for more clarification from the IRD about the actual implementation of new PE requirement, as well as the interaction with Hong Kong's traditional source rule.
In 2018, Hong Kong introduced country-by-country reporting requirements for multinationals with a presence in Hong Kong. These reporting requirements are made up of two obligations, but the first thing to do for multinationals to check whether they exceed the consolidated revenue threshold of 6.8 billion Hong Kong dollars or 750 million euros per year. If so, multinationals must file the notification within 3 months of the end of the accounting period. This will contain factual details about their Hong Kong entities and the name and location of their ultimate parent entity. It's worth noting that multinationals may choose to file one notification to cover all their Hong Kong entities at the same time. And on to the local filing of the CBC report. The CBC report contains factual information about the global allocation of income and taxes for the multinational group. This is due 12 months after the end of the accounting period, and with the first CBC report due at the end of December 2019. The CBC report filing obligation exists for multinationals which are either headquartered in Hong Kong or have an ultimate parent entity which is resident in a jurisdiction that has a double tax agreement with Hong Kong but has not yet activated country-by-country report exchange arrangements with Hong Kong. As transfer pricing rules were brought in last year, Hong Kong has introduced grandfathering provisions to ease transition into the new rules. Grandfathering provisions mean that the new transfer pricing rules do not apply to certain historical related party transactions. The date of commencement for the grandfathering provisions applies to related party transactions executed before 13th of July 2018. In this respect, the date of the agreement is not determinative. What the IRD has said is that they will look at whether the terms are complete and effective for both parties before the commencement date, and whether the arrangement actually constitutes separate transactions when determining whether the grandfathering provisions apply. The simplest example of this is an intercompany loan arrangement with multiple drawdowns. In this case, the IRD has said that each drawdown may be considered to be a separate transaction for determining whether the grandfathering provisions apply. If each drawdown is considered to be a separate transaction, then the grandfathering provision will only apply to those transactions conducted before 13th of July 2018. If, however, the whole loan arrangement is considered to be one transaction and payments are made after the commencement date, then the grandfathering provision will still apply as long as the agreement has been signed before 13th of July 2018.